In Florida, politicians boasted of historic tax relief, but behind those headlines, local governments still depend on property taxes for half their budgets, and home values jumped up to 60%. Homeowners counted on $1,200 in savings, but many got only a fraction. Hidden fine print, caps, and exclusions meant relief vanished and insiders reaped the rewards while leaders stayed silent. Who really profited, and how did the promise fall apart? Local governments across Florida rely on property taxes as their main source of funding. State budget documents show that year after year, these taxes make up nearly half of all local revenue. City halls, county commissions, and school boards build their budgets around this steady stream, using it to pay for police patrols, fire protection, road repairs, libraries, and parks. Without property taxes, basic services would grind to a halt. In 2025, as home values soared by as much as 60% in some counties, the pressure on these budgets only grew. Local officials faced a difficult reality. Rising property assessments meant bigger tax bills, but also ballooning expectations from residents demanding more services and relief from runaway costs. The numbers leave little room for doubt. In Miami-Dade, Hillsborough, and Orange counties, property taxes alone covered between 48 and 52% of all local spending. Even modest shifts in these revenues send shockwaves through public payrolls and contracts. When Tallahassee politicians announced new tax relief, local leaders scrambled to calculate what it would mean for their bottom line. Every dollar cut from property taxes threatened to show up as a shortfall in school budgets, emergency response times, or maintenance crews. For many local governments, there was no easy way to absorb those losses. Unlike the state, cities and counties cannot print money or run deficits. When property tax collections dip, the only options are to cut services, raise other taxes, or find creative accounting maneuvers. This dependency gave property tax relief measures enormous weight. The promise of $1,000 savings for homeowners sounded like a windfall, but for city managers and county commissioners, it raised urgent questions about how to keep the lights on. The backbone of local government in Florida is built on property taxes. Any change, however small, reverberates through every neighborhood, every classroom, every firehouse. That is why the debate over relief was never just about numbers on a bill. It was about the survival of the services millions of Floridians count on every day. Homeowners across Florida opened their annual property assessment notices to numbers that looked almost unreal. In counties like Miami-Dade and Hillsborough, property values shot up by 40 to 60% in a single year. For a typical family with a $400,000 home, that kind of spike meant a tax bill that could swallow a month's salary. The political response arrived fast and loud. Lawmakers in Tallahassee, backed by the governor's office, rolled out a sweeping promise. They called it historic property tax relief. Campaign mailers and press releases spelled out the headline, up to $1,200 in savings for the average homeowner, starting with the next tax cycle. The message was everywhere, on social media, in town halls, in glossy flyers that landed in mailboxes from Jacksonville to Tampa Bay. Legislators pointed to the numbers, repeating that families would see real money back in their pockets. The governor's communications team pushed the $1,200 figure as a lifeline for working people squeezed by inflation and runaway housing costs. News clips replayed the same talking points. Relief was on the way, the state was stepping in, and homeowners would finally get a break. For many, the relief could not come soon enough. The pressure had been building for months, with local news outlets running stories of retirees considering selling their homes and young families stuck with bills they never expected. In the heat of the 2025 session, lawmakers staked their reputations on the promise that this time the savings would be different, meaningful, direct, and fast. But as the details spread, the relief package took on a life of its own. The $1,200 figure became the centerpiece of news conferences and campaign speeches. Legislators framed it as proof that government could deliver for ordinary people. The promise landed just as property owners scoured their bills, desperate for any sign of relief. For Florida's lawmakers, the message was simple: help was coming, and the numbers would finally add up in the public's favor. Buried in the fine print of Florida's property tax relief package, a set of restrictions quietly limited just how much savings homeowners would ever see. The statutory language imposed a 3 to 5% cap on the annual growth of assessed value for homesteaded properties. On paper, that sounded like protection from runaway bills. In practice, it meant that in years when home values jumped by 20% or 30%, The tax bill could still rise by hundreds of dollars, just at a slightly slower pace. The cap did not apply at all to new purchases, rental properties, or commercial parcels. Condos, second homes, and small businesses found themselves excluded from the headline relief. For many, the promised $1,200 in savings shrank to just $200 or less once the exclusions and caps were factored in. Even among homesteaded owners, only those who had lived in their homes for years saw meaningful cuts. Recent buyers, renters, and working families in multi-unit buildings were left out. The law's language protected certain categories but left broad swaths of property owners facing the same rising bills. These foundational limitations set the stage for even more surprises in the way relief was phased in and distributed. The fine print of Florida's property tax relief did not just stop at caps and exclusions. For many homeowners, the headline savings were pushed further out of reach by a slow rollout schedule. The legislation staggered the promised benefits over 2 to 5 years, meaning that what was advertised as immediate relief would only trickle in, sometimes just a few dollars at a time. For a family expecting to see a major drop in their tax bill the following year, the reality was a gradual phase-in that left most of the savings on paper until well after the next election cycle. Consultants who reviewed the bill's language point to these phase-in clauses as a classic way to limit fiscal impact without drawing headlines. Instead of a flat $1,200 cut, most homeowners received a fraction in year one, with the rest dripped out slowly, if at all. These delays were especially frustrating for seniors who were told they might qualify for full exemptions, but then discovered an income threshold set at $350,000. Anyone above this cutoff, or who had not lived in their home for at least 5 years, was excluded from the most generous relief. The combination of drawn-out timelines and strict eligibility filters quietly shrank the pool of people who would ever see the full savings. For many, the promise of historic relief became a waiting game, with each year's notice revealing just how little had changed. Policy analysts note that these procedural shields buried deep in the bill served as a buffer for state and local budgets at the expense of the very homeowners the relief was supposed to help. Inside the Capitol, legislative maneuvering became its own kind of firewall. Florida's House and Senate rules require a 60% supermajority to place any constitutional amendment on the ballot, including those that would overhaul property taxes. That threshold set decades ago was pitched as a guardrail against reckless changes. In practice, it gave legislative leaders a powerful tool to shape or stall relief proposals behind closed doors. Committee records from the 2025 session show amendments surfacing just hours before key votes. Provisions limiting relief to non-school taxes or tying exemptions to triennial assessments instead of annual ones appeared in the final language with little debate. These late changes sidestepped public hearings and left even some lawmakers scrambling to decipher what would actually reach voters. A consultant who tracked the bill's progress said it was a game of musical chairs, and that by the time you realize what is missing, the vote is already done. The result was a set of proposals that looked generous in press releases but were carefully engineered to withstand scrutiny from both fiscal hawks and local governments. With the 60% rule in play and committee amendments dropping at the 11th hour, the real story of property tax relief was written in the margins, out of sight, but never out of consequence. January 12th, 2024. The Governor's Task Force files its first report on property tax waste, citing over $1 billion in questionable spending across Florida's counties. March 3, 2024. House Joint Resolution 7017 is introduced, proposing annual inflation adjustments to the homestead exemption, but only for non-school property taxes. July 15, 2024. Legislative analysts circulate a memo warning that the proposed exemption changes could reduce local budgets by $22.8 million in the first year, with the impact growing in later years. September 9, 2024. Lawmakers receive polling data showing 72% of voters support reform, fueling a new round of campaign ads promising $1,200 in annual savings for homeowners. October 2, 2024. The Florida House releases 8 competing relief proposals, including caps on assessment growth and expanded exemptions, but internal emails reveal concerns about shifting too much of the tax burden to renters and businesses. October 20th, 2024. Committee records show a late-night session where amendments are added to limit relief to non-school taxes and phase in changes over several years. Each date marks a step in the official timeline, a breadcrumb trail of decisions, warnings, and political calculations that shaped the final relief package. Anonymous staffers inside the Capitol traded messages that painted a far less hopeful picture than the one broadcast to the public. On October 2nd, an internal email circulated among legislative aides warning that the relief proposals would shift the tax burden onto renters and small business owners, leaving many homeowners with little more than token savings. The email flagged concerns about the narrow scope of exemptions and the risk of local governments compensating for lost revenue by raising other fees. While lawmakers stood before cameras, promised $1,200 back in every homeowner's pocket, staffers quietly questioned whether the math would ever add up. Just weeks later, on October 20th, committee records show a late-night session where amendments were tacked onto the bill, further narrowing who would benefit and stretching out the timeline for any real savings. Outside the chamber, a rally drew hundreds of residents demanding answers, but inside the doubts remained buried in draft memos and whispered conversations. The disconnect between what was known behind closed doors and what was promised in public set the stage for the coming fallout as the reality of the relief package slowly came into focus for the people who needed it most. Homeowners who expected to see a dramatic drop in their property tax bills found something else entirely when the new numbers arrived. Instead of the promised $1,200 in savings, the median cut across Florida landed at just $234, with most people falling in a range between $200 and $400. In Miami-Dade, a retired teacher living in a modest homestead saw her tax bill shrink by less than $20. In Orange County, a young family who bought their first house in 2022 received an official notice showing a $1,100 relief line item, then watched it vanish through higher assessments and local millage increases, leaving them with a net savings of $213. Data pulled from post-implementation trim notices confirmed the pattern. Even after all the fine print, the average homeowner's savings barely covered a week's worth of groceries. Nearly 1.2 million properties did not qualify for any relief at all. For those who did, the headline figure was out of reach, replaced by a number that felt more like a rounding error than a rescue. The gap between what was promised and what appeared on the bill was impossible to miss. As the dust settled, the question shifted from how much residents would save to who, if anyone, had actually come out ahead. Money that was supposed to lighten the load for homeowners instead found other destinations. In Hillsborough County, $250 million in property tax revenue over 10 years flowed to nonprofits, many with no clear link to lowering anyone's bill. One group, the East Tampa Business and Civic Association, collected more than $100,000 a year, while its executive director earned a six-figure salary funded by public dollars. These organizations, positioned as community partners, became steady recipients of taxpayer money, even as residents saw little relief. Commercial landlords also benefited. In Orange County, a single landlord holding dozens of rental units pocketed $3.8 million in property tax breaks, thanks to exemptions written into the fine print. Urban planning firms, some collecting $240,000 a year for equitable tax studies, landed contracts funded by the same pool of dollars meant for relief. Meanwhile, LGBT service organizations and other nonprofits received hundreds of thousands in grants, all justified as community investment. The pattern repeated across counties. While homeowners waited for savings, the largest checks went to entities with close ties to local officials or well-placed lobbyists. In the end, the flow of money revealed who the real winners were, not families struggling with higher bills, but a network of nonprofits, commercial landlords, and consultants who turned property tax relief into a dependable revenue stream. Campaign finance records show a steady stream of money flowing into Tallahassee from groups and individuals with a stake in Florida's property tax system. Over the past 2 years, more than $1.2 million in donations landed in the accounts of key lawmakers and political committees. Many of these donors share connections with the very nonprofits and commercial landlords who benefited from the relief package's fine print. Names that appear on county grant lists also show up in campaign disclosures, sometimes within days of legislative milestones. Lobbyists for urban planning firms and large property owners attended closed-door briefings, their presence noted in press logs but rarely mentioned in official statements. As the numbers failed to add up for homeowners, public calls for accountability grew louder. Reporters submitted formal requests for comment to the governor's office on October 23, 2025, seeking answers about the gap between promised relief and actual savings, and about the role of well-connected donors in shaping policy. No reply came. The silence stood in stark contrast to the flood of campaign promises and press releases that had filled the previous months. While ordinary Floridians searched for relief in their tax bills, those closest to the money trail found little reason to explain the outcome. The paper trail sits in the open, but the answers remain out of reach. Today, Florida homeowners face rising bills while the real relief drifts further out of reach. As legislative promises meet the reality of hidden caps and shifting benefits, trust in government transparency erodes. The stakes aren't just economic, they are about who the system truly serves. In moments like this, silence isn't neutral. It is a statement, all its own. What do you think? Share your thoughts below.